There is a look at the TSX and the S&P 500 over the past month, and you can see our market has been catching up. Of course, U.S. stocks surged after the Republican sweep on November 5th, but they have given up a lot of those gains. Our guest says he is trimming his exposure to U.S. markets and increasing his exposure to the TSX. We're joined by Philip Petursson, Chief Investment Strategist at IG Wealth Management. Great to see you.
Good to be here.
So that's interesting. The TSX is keeping up over the past few weeks with the S&P 500.
Yeah, with a smoother ride up. If you saw that on the chart, you had the S&P had that Trump bump up, and then perhaps cooler heads prevailed and said, well, maybe we got a little bit ahead of ourselves and things came back down. But the TSX along the way has just been steadily climbing. And this is, I think, a positive that can continue into 2025.
And it's interesting, too, that the oil price is not really doing much. It's been stuck below $70 a lot of the time over the past few weeks. And still, our market at or near record highs.
Exactly. And that's a good thing. That's a healthy market. That means there's broader participation across the TSX. But that oil question, I think, can come in and benefit the TSX into 2025. If you see any change in the oil price higher because of geopolitical risk emanating out of the Middle East, or if we just start to see prices just gradually increase to our target of, say, $75, that's good for the energy sector. That's good for the TSX overall.
What areas in particular in Canada do you favor?
Okay, so we just touched on energy. That's
Sure.
one area that we think has some positive catalysts. But the other one, and especially with the inflation data that came out today, is financials. And so what we're seeing is a long end of the yield curve that's staying anchored in the U.S., let's call it around 4 to 4.5% on the 10-year Treasury, while the Fed cuts. And the Bank of Canada cuts as well. And the Bank of Canada, we think, has a path that's going to lead it lower than what we see in the United States. So we'll have a normalized yield curve, which means lower short end of the curve, higher long end of the curve. That's good for the banks. That's how they make money. And so we see financials as being very, very attractive going into next year.
Because a lot of the deposits are short-term and they pay short-term interest rates.
Exactly. The bank's business is borrow short, lend long. And so the greater the difference between short and long rates, the higher the net interest margins for the banks, the higher profitability. And so we see the banks as attractively valued right now. They're offering a very attractive dividend, and they're offering upside in terms of earnings growth.
Interesting. Well, Bank of Nova Scotia, maybe we could put that up without getting into it in particular, but I've seen 3 upgrades for Bank of Nova Scotia over the past 48 hours. I know that's just one bank, but there seems to be a lot of support for the Canadian financials.
Exactly. And as I mentioned, along the way, you're getting paid a very attractive dividend that will offset some of the lower interest rates that we see in the bond markets.
You do, the yield on Bank of Nova Scotia right now, or as of yesterday, was 5.5%. You do see a risk of this so-called mortgage cliff as Canadians renew mortgages at much higher rates?
We do. When you look at the banks in aggregate, we have about 25% of outstanding mortgages come due next year. When we stress tested in terms of, okay, what is the change if we use the 5-year as our benchmark? What is the difference in the 5-year expiring rate versus the renewal rate? And we even discount the current rate by 100 basis points, and still it can be upwards of 75 to 100% greater than the expiring rate. So it could be double what we're seeing. And that's stress on the Canadian consumer that they're going to have to find a way to spend less elsewhere to make their mortgage payments. Is
there a risk of defaults, do you think, or significant defaults?
Significant, no. I think if you look at just the Canadian household balance sheets, they're okay. They can absorb the increase on the mortgage costs, but it's going to come at a cost elsewhere, and that's where we can see the Canadian economy facing headwinds from slower consumption.
What about bonds? Are you interested in owning long-term bonds right now?
Yeah, you're offered an attractive yield. We don't see the rate environment on the long end of the yield curve moving up substantially from here. So if you look at, say, U.S. long bonds, you're getting paid mid 4%, and that's attractive. And bonds also have returned to their more defensive characteristics within a portfolio that in times of stress, in times of volatility, should offset equity market volatility.
What about the Trump trade? Would you think Canada will broadly remain under pressure because people are worried about tariffs?
That's another economic headwind. I don't think it's as much of a stock market headwind, but I think it is a headwind for the economy. And this is coming back to the Bank of Canada and what they need to focus on. If we have a couple key things in Canada, it's the mortgage cliff coming. It's unemployment that has been creeping higher. It's not concerning, but the trend is in the wrong direction. And it's inflation fight that's been won. So it says to the Bank of Canada, keep cutting because the economy should be the greater focus as opposed to inflation.
And you feel the Canadian dollar, let's have a look at it. It has been weak against US dollar almost entirely because the US dollar has been strong against currencies around the world. At what point do you think the Bank of Canada might get worried here?
Yeah, this is where the Bank of Canada is stuck between a rock and a hard place, because if they continue to cut at a faster pace than the Fed, then what you're going to see is a continued weaker Canadian dollar. That's why we've seen pressure on the Canadian dollar, because the Fed is saying we're going to go slow. Bank of Canada, I think, that it needs to move faster. So our target right now is 70 cents. So we do think that the trend for, or the path for the Canadian dollar is lower. The Bank of Canada is going to have to tolerate that for a time, because the lower interest rate environment is more necessary to the health of the Canadian economy than a strong loonie.